Hi, I'm Mark Farber, and this is Accounting Fundamentals. What we've been doing up till now is we started to record transactions. So we looked at transactions a few videos ago and just kind of keeping track of things that a company does without using accounting, so to speak, but just keeping track of increases and decreases in cash and revenue, etc. Then we introduced the concept of debits and credits, and we recorded those same transactions into a journal. And we said that in order to make sure that our accounting equation remains in balance, we just have to make sure that the debits and the credits from each transaction are always equal to one another. We next wanted to see how much we had in the various accounts, so we took all of our transactions out of our journal and we posted them into the ledger accounts. And that's what we have over here from the last video, is those ledger accounts that we created. And so we can look at this now and we can say that at a particular point in time, whenever we decided to stop, and it's usually at the end of a month or at the end of a quarter or the end of a year, we've calculated the totals in each of our ledger balances. And they're very simple because we only have 5 transactions here. And we've determined that we had a debit balance of $500 in cash. And notice that I say a debit balance. We don't talk about plus $500 or minus $500. We talk about it always in terms of debit and credit. So a debit balance of $500 of cash, debit balance of $3,000 in accounts receivable, a debit of $2,000 of equipment, a credit of $3,000 in revenue. But we've lost that ability to see when we look at our ledgers, are we still in balance vis-a-vis the accounting equation? Did we make a mistake when we took all of our transactions out of the journal and we posted them? Did we accidentally turn a debit into a credit or vice versa, or record a number wrong or something? So we need a way before we continue on to double check that everything still balances out, because remember, once it's no longer in balance, our accounting just won't work. And so what we use is something called a trial balance. And a trial balance is a document that's prepared by companies, and it's an internal document, so they don't show this to anyone, but it's used as a double check and also as a means of very quickly seeing the balance in all of the accounts all in one place. And so what we're going to do is we're going to just create a very simple trial balance over here. As with any form or any report that we create, at the top it's going to have the company name. I didn't name our company, so I'll just write company name. Then it's going to have what kind of report it is. In this case, it's a trial balance. And then, very importantly, and we haven't been putting in dates, just to keep things simple, but you always record the date that you did the trial balance on, because that's going to tell us that on this date, this company had $500 of cash. Tomorrow it might have more cash or less cash, so it's only good as of that date. And then what we're going to do, make a little column for debits and credits, is we're going to list off all of the accounts, and they get listed in a particular order. Remember when I did this? I did assets, liabilities, equities, revenue, and expenses. We can just put in our little pluses and minuses to remind ourselves again. Okay, that's my little cheat sheet that I use to kind of keep track of whether I should be debiting or crediting something. I wrote it in a very specific order, and you should get used to that order. Assets, liabilities, equity, revenue, expenses. That's the order that we're going to always list things off, and we'll see later on that there's a reason for that. For now, let's just go with it. So I'm going to list off first my assets. So I've got cash. And cash has a debit balance of $500. So I'll put in $500. Next, I have accounts receivable. That's also an asset. I'm just going to rate it as AR. And that has a debit balance of $3,000. Then we have equipment, also an asset. Remember, assets are things that the company owns. It owns its equipment. The equipment in this case was a computer, $2,000. And that's it for our assets. Now, there's no liabilities in this company. They don't owe anyone any money, so we can ignore that. Next, we have equity. Well, there's capital. So, capital. And that's a credit balance of $5,000. Again, be very careful that you get things in the right column here. And withdrawals is a negative form of equity, if you will. but it's a form of equity nonetheless, so we'll put in withdrawals. It has a debit balance of 500. Next, we have revenue. And my revenue is $3,000. It's a credit balance. And finally, we had one expense, rent expense. And that was $2,000, again, a debit. Okay, so there's all of our accounts just nicely organized in two columns. So what, you say? Well, now I can add up the columns. On the credit side, I have 5 plus 3,000, that's 8,000. On the debit side, I have 3, 5, 7, and another 1,000 is 8,000. In other words, my debits equal my credits still. So I know that if all the debits equal the credits, I should still be in balance. I haven't made any mistakes. If there were mistakes, we can look at those later on and figure out how we're going to fix them. But this tells me that after having gone through the process of taking all of my transactions from my journal, posting them to my ledger, I haven't made any errors. Everything is still in balance, and I can continue with the accounting process. The other thing this does is it gives me another visual check. Because remember, we said assets are debit accounts. So here's my assets. And notice that they all have debit positions, which is good. Liabilities we don't have. Equity is a credit account. Well, there's my equity accounts. The bulk of it is a credit. There's a small debit, the withdrawals. But remember, we said withdrawals are kind of like a negative on equity. It's a reduction in the company's equity. Revenue is a credit account. In fact, revenue will always, always, always only have credits in it. You can never, ever debit. Well, there's one time when you can debit revenue. We'll see that shortly. But otherwise, it will always have a credit balance. And my expenses are debit accounts. So there's the expenses, and it's in debit. So another way of checking to make sure that everything looks right before we continue on, because now things are going to start to get interesting. What we're going to do next is we're going to look at the difference between what's called cash accounting and accrual accounting and figure out what that difference is and how it impacts what we're going to be doing going forward, which is going to be adjusting accounts. Okay, so now it's going to start to get a little bit more interesting. See you soon.